Good morning, ladies and gentlemen. I'm here today to share with everyone the latest developments in the lithium industry and importantly, the critical role that Galaxy is now playing into this very high growth and exciting market that we have in front of us. Galaxy, as Eric pointed out, is listed in Australia. We're an ASX 200 company. We are purely lithium focused. We're also very unique from a perspective that we're only one of two Western companies that actually have a diverse portfolio of assets. We actually have exposure to both hard rock and brine-based lithium assets. Our assets are located in Australia. That's where our production, our mine going into production is, and also we have a brine asset in Argentina, and last but not least, we have another hard rock project in Canada. Mount Cattlin, which is in Australia, is about to deliver its first shipment before the end of this year. We started commissioning ore through the plant over the last week or so. But our flagship development really is the Vida lithium and potash brine project in Argentina, which is actually very strategically located on the same salar as FMC Lithium. And for those of you who are familiar with the lithium industry, FMC is one of the top 3 global producers. As I mentioned, we have recently been included into the ASX 200 index. Our market cap is around the mid-600 range. We have a little around approximately $20 million in terms of pro forma net debt, and increasingly getting covered by a whole variety of institutions, Canaccord, Bell Potter, Baillie, Hartleys, and I believe also UBS is in the process of picking up coverage on us as well. Board and management, currently we own probably just under 6% of the company. As I mentioned, we have a very diverse asset portfolio, unique not only in its diversity, but the fact that we have actually existing production, as well as a very strong development pipeline through our assets in Argentina and Canada. Just to give you some perspective, over the last 20 years, in brine projects, there's literally only been about 4 or 5 projects been built throughout the world. And in the hard rock space, it's even less. There's only 3 projects that have been built, including ours, which are about to either are in production or about to go in production. So it's actually a very, very small circle, and we have a very good footprint globally. Historically, we did actually used to have another business in China. It was a lithium carbonate processing facility, which basically took our lithium concentrate from Australia and shipped it to China, where we would convert it into lithium carbonate. And lithium carbonate is one of the main feedstocks that is used in the production of lithium-ion batteries. It's used mainly in the cathode, but also in the production of the electrolyte for the lithium battery as well. Interestingly enough, Asia today represents close to 90% of all the lithium-ion battery manufacturing capacity in the world. China itself is probably somewhere in the region of 55%, closely followed by Japan and Korea. But actually, if you combine Japan and Korea and multiply it by another 1.5 times, it's still smaller than China. So increasingly, this is becoming a very strategic industry for China. And by definition, a lot of the lithium-ion battery value chain, when you go from not only the end user to the battery, to the battery materials, the cathode, the electrolyte, the separator, the anode production, much of that basically sits in North Asia. And that's why increasingly you're seeing more and more of the world's lithium units migrate to that part of the world. And through the Jiangsu operations that we actually used to own in China, we've been very fortunate to build up a very strong customer base of over 40 customers who produce all sorts of battery materials. So what is the demand and supply situation of the lithium market in the world today? Based on our estimates, 2015, the world consumed about 162,000 tons of lithium carbonate equivalent, which is our standard measurement of lithium in the industry. Out of that, China was the single largest consumer as a single market, 70,000 tons out of that, closely followed by Japan and Korea with 21 and 18,000 tons respectively. Out of that 70,000 tons, 70% of what China consumed actually ended up going into a battery. On a worldwide basis, that percentage is about 40%. So lithium is also used in many other traditional industrial applications, such as grease, ceramics, and glass. But lithium batteries, by far and large, is the highest growth sector and is likely to become the largest segment going forward. China also last year became the single largest producer of lithium compounds, not lithium resources, because interestingly enough, most of the lithium that gets produced in China, or lithium compounds that gets produced in China, close to 90% of those compounds actually have to come via feedstock that comes from overseas, either from Australia or from South America, which is a complete opposite situation to what it has in the rare earth industry. So China last year surpassed Chile with 70,000 tons of production. Chile historically has been the biggest producer, and now they're only at 57,000 tons. So off the back of that 162,000 tons, going forward, what should we expect in terms of future growth? Well, between now and 2020, there's a whole range of broker estimates that are out there. But roughly speaking, they range somewhere between 120 to about 180,000 tons of incremental demand coming online. And so basically what that speaks to is somewhere in the region of additional 20 to 30,000 tons of demand will be coming online every single year. And so where is that demand being driven from? A lot of it is increasingly being driven from the electric vehicle and the hybrid vehicle industry. Historically, if you look at world output last year, probably somewhere in the region of 3/4 of the world's output was probably, in terms of lithium batteries, ended up in these things, consumer electronic devices like laptops and tablets. But increasingly, that quarter share through the auto sector is growing larger and larger. And mathematically that is happening because the format sizes of the batteries within the auto vehicles are so much larger than in the typical consumer electronic device. So just to put it in perspective, an iPad, the iPad, first generation iPad, was a 25 watt-hour battery. And I personally actually drive a Tesla. It's a very large battery. It's an 85 kilowatt-hour battery. But if we took a normal car, let's say, for example, a Nissan Leaf, that's a 24 kilowatt-hour battery as the first generation Nissan Leaf was. So literally, you're talking about 1,000 iPads for each electric vehicle that we see on the road today. And so what you can probably imagine is that you don't actually need to sell a lot of electric vehicles to eat up a lot of lithium. And that scale keeps growing as well. So when we talk about a Nissan Leaf compared to, let's say, for example, a Tesla Model S, you're talking about 3 Nissan Leafs in one Model S in terms of battery size. But then there are also other vehicle types that are actually being developed to go electric. In China, a big growing sector are commercial vehicles and also public transport buses. In a commercial vehicle, you're talking about somewhere between 1.5 to 2 times the size of a Tesla inside a delivery van. And inside a bus, it's 3 times the size of a Tesla. So you're talking about 200 plus kilowatt hours for an electric bus in China. And currently there are 500,000 buses in China, and the government wants to convert about 200,000 of them to electric. They've probably got through about 70, 80,000 so far. So as you can see, mathematically, as the auto sector drives this electrification, we don't need to go to very, very high penetration rates of electrification in that auto sector. If you hit 5%, 10%, it's already a very, very big impact on the lithium industry. And so what I've tried to do on this particular page is measure that impact. And we can run all sorts of sensitivities on this. And what I decided to do was look at all of the country targets and see what they stated as their 2020 objectives to electrify their transportation. And as a total, it works out to be roughly about 18 million vehicles, of which there are about 1.2 million vehicles on the road as of 2015. So at the bottom part of that slide, you will see a table which basically says scenario 1 and scenario 2. And scenario 1 basically assumes a certain size of the battery in those vehicles, and scenario 2 is a slightly larger battery. And that battery size that we've assumed is only 30 kilowatt hours and 40 kilowatt hours. And roughly speaking, we would normally assume 0.8 of a kilogram to feed 1 kilowatt hour of energy storage. So by calculating all of that, we can actually measure the impact on the lithium demand side in terms of those vehicles being adopted and fully deployed. And we're talking about a range of somewhere in the region of 400 to 500,000 tons of lithium carbonate equivalent, off the back of 162,000 tons that the world produced last year. So clearly, there's going to be a gap. And in our view, I don't think it'll be very, very hard for those targets to be met 100% across the board. And one of the reasons is because the supply side is, at the moment, very lagged and very slow to respond. And why is that? One of the primary reasons is that, as we all know, within the mining and resources industries, is that projects take time to come online. And within the two categories of lithium projects, you have hard rock and brine. And typically, if you're going from a post-DFS, you're fully funded. If you're starting from a standing start into steady state production, you're taking somewhere in the region of about 2.5 to 3 years to get there. About a year and a half to construct your project, and then about another year to year and a half to go through commissioning and then into steady state production. So in a hard rock scenario, which is the best scenario that we can have because they're a lot quicker to get online, it's 2 to 3 years. Within a brine project, it's actually much more challenging. A brine project typically takes about 2.5 to 3 years to build, and then it takes another 3 years to actually ramp up. So you're talking about 6 years before that product comes online, assuming you are fully funded today. So what we tried to do on this particular side is look at the level of investment that's actually gone into the lithium industry and actually what it actually needs in order to bring that supply online to actually meet that demand and have a chance of at least balancing that demand over the next 3 to 5 years. And what we discovered was this. We had a look and opined on what were the next half a dozen projects to come online. And the total capex number that we arrived at was 2.3 billion Australian dollars, which is just under 2 billion US dollars. And then we actually looked back over the last 12 to 15 months and tried to figure out, well, exactly how much capital has been raised for these projects, within the whole public equity markets. And we also looked at the private transactions as well. And the number that we came up with was less than 500 million Australian dollars. So basically, the situation that we have on the supply side at the moment is a significant level of underinvestment in order to actually bring those projects online. For the start, I think between 2017 and 2019, the whole demand-supply situation remained very tight because many of those supply projects will not come online because as of today, they're not fully funded. And so what that's led to is a continued robustness in lithium pricing. The last time I was here was in March of this year, March 22nd, and lithium pricing had already started running at that point. It was probably at a slightly higher level than where we are today. And actually through Q2 of this year actually ran all the way to, if you're talking about hydroxide, north of $20,000 per ton. And carbonate was actually close to $20,000. Now that pricing, in particular in China, has actually come off a little bit, about 25 to 30%. So in China today, you're talking about 15 and 18,000 US dollars a ton net of VAT, okay, for carbonate and hydroxide respectively. But one of the interesting things that's happening in the lithium world at the moment is historically China used to be a price taker. So the South Americans, particularly the Chilean projects, used to set the price and China would follow. Now that China has become not only the largest consumer, but the largest producer of lithium compounds, China is now starting to exert its influence on setting price. Now, because 70% of what China actually produces is actually based off a hard rock feedstock, it obviously has to sell that at a higher price because hard rock operating costs for a converter are actually higher to actually produce lithium than a brine project. So as a result, today we have a price level which is approximately 2.5 to 3 times the level of where we were at the beginning of 2015. And for the time being, probably over the next 2 or 3 years, in light of the fact that the supply response will still be a little bit lagged, we're probably going to continue to see some very robust pricing going forward for the next 2 or 3 years. I've talked a lot about China. It's very much a policy-driven country. So a lot of their targets are very lofty compared to the rest of the world. 5 million electric vehicles on the road by 2020, 200,000 buses, 50% of government fleet vehicles will have to be converted to electric by 2020. But the vehicle side is not the only place where the government is investing. Last year, the government plowed somewhere in the region of 30 billion renminbi into the new energy vehicle sector as by way of subsidies and all sorts of government funding. This year, a lot of that funding is now being redirected to charging stations. So the government has an ambition to actually deploy somewhere in the region of 4 million charging stations, close to 1-to-1 ratio for each vehicle that's on the road by the end of this decade. So this is, for China, it's a strategic imperative. It's less so about, being environmentally friendly, which is actually important. But for those of you who've actually traveled to China very regularly, and I go once or twice a month, and I lived in China for many years as well, China is becoming a very difficult place to live now because of a lot of the pollution in the major cities. And so the electrification of transportation is a big strategic imperative for China, notwithstanding the fact that electrifying their transport fleets also allows China to de-lever the over-reliance that they have on imported foreign oil, which is also a strategic imperative for them. Like I said, we're listed on the ASX, and some of you who have maybe followed a little bit about lithium may have also encountered a lot of noise. There are a lot of junior companies out there who, at least on the ASX, are over 100 who all claim to have a lithium project. But actually, when you go through a box-ticking exercise to basically figure out how many of them are, permitted, have a resource against it, or even have a pre-feasibility study, feasibility study, or even anywhere near production, that list tends to get very short very quickly. And so I will point you to the left-hand side of that chart to figure out who the final names on that list should be. So what do we have? We have the first of our projects is the Mount Cattlin project, which we recently made a 1.6 million ton expansion to. So that mine this year, in 2017, our production guidance is for 160,000 tons of lithium concentrate at a roughly kind of 5.5%. Now this level of production is only starting at our fairly conservative guidance of a 50% yield. But throughout the course of next year, we'll anticipate that we'll be working that through to about 70% as the plant continues its optimization. In terms of cash flow, so far this year we've signed 45,000 tons at $600 a ton, and we've got commitments so far for 2017 of 120,000 tons of lithium concentrate. I've actually started my negotiations with offtake customers already to finalize pricing for 2017, but we're hopeful that we can aim for something which is close to a $400 margin off the top of that. So essentially something which has a 7 in front of it is where we're going from. So continued kind of price increase on that lithium concentrate price going forward. So if you do the math on a pro forma basis, 160,000 tons, $400 per ton kind of margin, then you're looking at circa $64 million, which is about 85 Australian dollars at the operating level for Mount Cattlin in terms of operating cash flow. Our corporate overheads next year will probably be somewhere in the region of $7 to $8 million. So you're talking about $70+ million in terms of free cash flow next year. Through the history of Galaxy, we've also accumulated a lot of tax losses. We have over 214 million Australian dollars of tax losses. So hopefully we'll be able to operate for a good 2 or 3 years without having to pay any tax on that cash flow, and it will be a happy problem if we do actually have to start paying cash sooner rather than later. So if you look at the company's valuation today, and a lot of people ask me how to value Galaxy given that we have a number of projects, one very simple way is ascribing 2/3 of the company's value to, let's say, our existing production asset, and a third to the other assets. And mathematically you can turn it around any way you want, but on that basis you're talking about 440, 450 market cap or value ascribed to the Mount Cattlin asset. So if the Mount Cattlin asset at the operating level is throwing off north of $80 million on a pro forma basis, that basically puts the Mount Cattlin asset, or at least the Galaxy valuation, at circa 5 mid-single digit cash flow, so around 5 and a bit times free cash flow. Obviously you can run your own sensitivities, but that's basically kind of how we're being valued in the market at the moment. How far have we got on restarting operations? So we basically started commissioning ore already. So there is product coming out of the plant, and essentially we are looking at making our first shipment out of Esperance Port to our customers in China by the end of December 2016. Next up is Sal de Vida. This is our flagship development project located in the Salta and Catamarca province of Argentina. It's also located in a region called the Puna, and in the industry it's also known as the Lithium Triangle. So Lithium Triangle straddles Argentina, Chile and Bolivia. And as I mentioned before, we sit on the same sala, the Sala del Hombre Muerto, which is actually the same sala where FMC has been operating over the last 20 years. So in terms of infrastructure for rail, road, gas pipeline, electricity, reagents, even soda ash, which actually has to come from Wyoming in the US, can be shipped down to Antofagasta. There's a direct rail link across the mountains through to Antofagasta, and that can deliver reagents to site. It's a very large project. It's a 40-year mine life, 1.1 million tons of lithium carbonate equivalent, and over 4 million tons of potash. We recently completed a formal revision of the DFS for this project earlier this year in August. That gave us 25,000 tons of design capacity on the production of lithium carbonate, 95,000 tons on potash for a capital cost of $376 million US dollars. The ultimate NPV that we arrived at was 1.4 billion US dollars as a net present value on that particular project. How we're thinking about financing this project going forward is probably going to be a mix of debt and equity. We're looking at a range of a half to 2/3 of that 376 being financed through debt financing, either by way of project financing or ECA type of funding. With the remaining part coming through by way of an equity component. And we have several options that we can consider in terms of funding that equity component. First, we obviously have some organic cash flow from Mount Cattlin that we can deploy to fund that. Secondly, we have some discussions ongoing with off-takers with respect to the potential to secure some prepayments against the offtake from Sal Vida. And last but not least, we obviously have had some approaches with respect to taking a strategic stake in Sal Vida. So if we do consider going down that route, we could actually envisage a project sell down, which essentially will bring in sufficient enough capital to actually fund the equity component of the project while still be able to retain control. The economics of the project are very strong. So cost of somewhere in the region of 3,369 US dollars per ton for production of lithium. That's before potash credits. We've assumed a very bearish potash price in our model, somewhere in the region of 210 to 220 per ton of potash. If we do actually add potash credits to that, that will probably reduce that OPEX by another $410. So very strong economics on a post-tax basis, average through the life of the project, will be throwing off somewhere north of 180 million US dollars in terms of post-tax cash flow. Last but not least, we have another little project in a region of Canada called James Bay. It's in the Quebec province. And it's a very mining-friendly province. This is also a very similar project to, similar asset to Mount Cattlin, very coarse grade, very coarse spodumene. And essentially we will be looking to advance our DFS work on this project at the beginning of next year with a view to finalizing that through the year and be in a position to make a final investment decision on how we want to take this project going forward towards the latter part of the year. Essentially, we have a couple of options. One option is obviously just to build the mine and produce concentrate. The other option, given our experience in building and running the Jiangsu operations in China, we do actually have a second option of not only building the mine, but also building a conversion facility in Canada, located close to the mine itself. With a view to actually producing carbonate or hydroxide for the North American market. So with that, thank you very much for your time today. Just to share with you, I think we have a lot of milestones and interesting developments for Galaxy going forward, and I look forward to being able to see you all again next time and report on our progress. Thanks very much.
Thank you very much. Maybe the time for one question while I make the transfer over here, and be careful if you want to go over here, Anthony. Is there any questions from the audience, Monsieur Despatie?
Can you think about doing production with industrial mineral if you don't have secure the offtake?
A good question. On a typical commodity, normally what some projects actually do is you actually try and secure an offtake partner as an equity partner. So in a situation where you actually have some concerns about your ability to actually place that product in the market, it will be good to actually secure that offtake in advance. two strategies for us. On the hard rock side, at the moment, there is literally very much a very strong, a very overwhelming shortage of hard rock material in the market at the moment. China is adding somewhere in the region of about 50, based on existing producers before additional producers, somewhere in the region of about 56,000 tons of additional conversion capacity that will come online in China. And based on the new entrants that I see in that market, another probably about 40,000 tons of conversion capacity. So you talk about 80 to 90,000 tons of conversion capacity that wants to be built in China and is being planned at the moment. That, in hard rock terms, is equivalent to about 700,000 tons of hard rock, of spodumene required to actually feed those plants at 100%. Based on what the market is seeing at the moment, out of that 80, 90,000 tons, you only really have two hard rock projects, which probably over the next couple of years will be the only suppliers into the market. One being Mount Cattlin, which is our project, and another one being Mount Marion. Together, they will probably produce somewhere between 40 to 50,000 tons of that lithium carbonate equivalent. So when I'm having offtake discussions at the moment, the interesting situation is that it's very much a seller's market. So if this was an IPO book build, the level of oversubscription that we have in the book build at the moment is somewhere in the region of 2.5 to 3. Okay, so what we're talking about, for every ton of material that we're looking to produce, we probably have demand for 2.5 to 3 tons. So on that basis, what we're looking to do at the moment is probably sign not only offtakes for next year, but options over our volume going forward over a more longer term. So that's what we're doing on the hard rock side. On the brine side, as I mentioned before, the overall demand within the electrification, the auto industry, is going to be so large and dwarf the existing supply pipeline that, again, not only do we feel that there's not going to be a problem actually placing that product. In fact, the problem is actually on the other side of the table, is that if you're an end user, if you're an automaker or a battery manufacturer, you would start being, and we've seen this, there is starting to be a level of concern about the ability to secure raw material for all of these batteries that they want to build going forward. So probably some of the stories that you would have heard are announcements by Volkswagen, who wants to be producing somewhere in the region of 2 to 3 million vehicles per year within the electric fleet by 2025. Well, that's a lot of lithium. That's anywhere between 60 to 90,000 tons of lithium. So if you look at the pipeline of supply at the moment, we still very much have a situation where there's probably going to be more demand than supply. And so, again, for us, I think it will be a reasonably straightforward process to actually place the offtake. The more strategic decision for us is actually who we place that offtake to. So obviously we would like to be working with partners who actually have a much more longer term strategic vision in terms of their growth plans on the demand for lithium.
Okay. Hey, thank you again.
Thanks very much, Eric.
Great presentation.
Thanks.